Today's GDP numbers argue for more RBA interest rate cuts as household savings rise and household spending flatlines. The Australian Bureau of Statistics has just released the June quarter GDP numbers, and they make it clear that the economy is not heating up. In fact, household consumption actually fell 0.5% in the quarter. And so these numbers will only add to the case for more RBA interest rate cuts. So let's have a look at what's going on. After the data release, the Australian dollar fell against the US dollar from around 66 cents down to 65.30 cents, and it also fell against the euro from 62 cents down to 61.40 cents. Now, typically, if the GDP data was very strong, then the currency would have risen because that means the economy is doing well, which makes it more likely that the RBA will be able to increase interest rates further. But that's clearly not what happened today. The GDP data was weak, and the currency fell because this increases the chances of more interest rate cuts. Now, first of all, let's start with a chart of the GDP figures. This shows the annual change in GDP over time. We can see that GDP rose rapidly during COVID as government spending went through the roof. We can see that this red line for government net worth has come down significantly since then, because government spending has been cut back. But GDP growth slowed dramatically last year after the RBA started increasing interest rates, and it turned negative in the first quarter of this year. But now, the latest June quarter, we can see that GDP has turned positive again and is growing at 2.4%. If we look a bit deeper into the details, the main reason why GDP is rising is because of a big increase in exports. Exports rose by 8.7% over the year, which is the biggest increase since March 2021. So Australia is exporting more iron ore, gold, coal, beef, etc. to the rest of the world, and this is boosting GDP. Now, exports are good for the overall economy, but they don't do much for inflation. Inflation is driven mainly by domestic demand, and if anything, strong exports might even put downward pressure on inflation because businesses will need to use their export opportunities to get rid of excess stock that they've built up during COVID. What we really want to know is what's happening with household consumption, which accounts for about 55% of GDP. Household consumption rose a bit in the June quarter, but on an annual basis, it actually fell by 0.6%. This is not what we would expect to see if the economy was heating up. A stronger economy should mean households have more confidence about the future and they should spend more. But instead, household consumption is falling. If we look at the quarterly data, household consumption actually fell by 0.5% in the June quarter. This was driven by a 1.9% fall in spending on goods and a 0.4% rise in spending on services. Spending on goods is now actually 7.6% lower than a year ago. This is due to the sharp fall in spending on vehicles, which is down 20% year on year. Other big falls in spending are also on household appliances, furniture, and other goods. Why are households cutting back on spending so much? Well, the answer is pretty obvious. It's because they are worried about the future, and many of them are probably expecting a recession next year. Remember that wages are only just now starting to rise above inflation, and it takes time for wage rises to flow through into higher household spending. We can see from this chart that household disposable income has only just now started to rise above its pre-COVID trend. This is despite the fact that the RBA has been increasing interest rates for almost 2 years. If we look at how household income has changed over the year, we can see that wages have risen 7%, but this was completely eaten up by a 7% rise in household spending on interest. In other words, households are being squeezed by higher interest rates because they have to pay more money to service their mortgages. With wages only now starting to rise above inflation, it seems likely that the squeeze on household incomes will continue, and this will continue to weigh on household spending. And this is why the Reserve Bank will be reluctant to increase interest rates further. Another point worth making is that households are saving a larger share of their income. We can see that the household savings rate was 10% in June, which is the highest level since April 2021. That's because people are still cautious about the future and they want to save more. And this is another reason why the RBA won't want to increase interest rates any further. If people feel like they need to keep saving more of their income, that means that there's less money available to spend, which means less economic growth and less inflation. We can see that the household savings rate is still high because if we look back before COVID, the average savings rate was around 5 or 6%. So it's a lot higher than that right now. Now the question is, why are people saving so much more right now? Well, a big reason is uncertainty about the future. People could lose their job, they could get sick, or some other unexpected expense could come up. So they want to save more to self-insure against these risks. But also remember that people are paying off their credit cards faster than normal. And this is eating into household disposable income. If we look at this chart, we can see that the annual repayment of household credit is currently running at $16.5 billion. That's double what it was in June 2021. So households are saving more and paying off debt faster, and this is also contributing to the slowdown in household spending. There's a few other things worth noting. Business investment fell by 5.6% over the year. This was driven by a 17% fall in spending on buildings and structures and a 15% fall in spending on machinery and equipment. Again, this is a sign that businesses are cautious about the future. They don't want to invest until they know where the economy is heading. Government spending rose by 5.3% over the year, but most of this was due to spending on new government projects rather than day-to-day spending. For example, a lot of money was spent on the new National Anti-Fraud, Counter-Terrorism, and Cybersecurity Operations Center. But if we look at day-to-day government spending, this actually fell by 1.5% over the year. Net exports added 1.7 percentage points to GDP growth. As I mentioned earlier, this was mainly due to the big increase in exports. So overall, these GDP numbers show that the economy is not heating up. Household spending has fallen, and that's because households are uncertain about the future, and they are also under pressure from higher interest rates. And this is why the RBA will be reluctant to increase interest rates any further. Most economists expect the RBA to keep interest rates on hold for the rest of this year, and there's a good chance that they'll need to start cutting interest rates in early 2024. These GDP numbers only support that case. Now, one thing I didn't discuss in this video is the labor force data, which was also released today. If you'd like to find out what that data is telling us about the economy, I've made a separate video on that, which I'll link to here. Also, don't forget to subscribe if you haven't already. I'm from a financial website.